Welcome to Markets Now. I'm Michelle Rook with Dave Chatterton of Strategic Farm Marketing, and it was an update on everything but the cattle market. And Dave, let's talk about grains. We had kind of a roller coaster ride, but wheat ending with some double-digit gains. Was that all technical? Was it fund short covering? Because I know we're back above these 100-day moving averages, I think, in all three classes.
Yeah, a little bit of both, Michelle. I think interestingly, we're getting some technical performance finally starting to show up in the wheat. Wheat is the one market of the major contracts here where the funds have remained short the complex and a pretty decent short around that 90,000 contract mark. So we saw some money coming into the complex today, kind of an ugly opening here. But once we got past that and the buying started to come in, I think it's a beneficiary to see wheat, still short, wheat not rallying to the degree that corn and soybeans have. And we're finding that when these outside investors who don't know a lot about or track the market fundamentals of the grain very closely come in, they see corn as a very crowded trade. They see that beans are already long, and they see wheat maybe holding some relative value and pointing some dollars that way. So certainly that's a helpful cue here as we go forward.
So do you think, or at what point will the market start recognizing the lower crop in Russia and the higher prices that they have there and in Europe?
Yeah, it's been an ongoing, discussion in the wheat trade circle here for a while, and those values are creeping higher. Certainly, we're getting closer to being, at export parity or having some exports work out of the U.S. and out of other places, other than the Black Sea, I should say. We haven't seen a lot of evidence of that of late, and that's been kind of a fleeting carrot on a stick type of an argument here for the marketplace. And the fundamental picture in wheat is certainly improving. We're starting to see, like you said, we're moving above the 100-day moving average here, but rather than a fundamental basis for what's happening and seeing the commercial trade come into alongside the wheat, I think this is more money flow and outside speculative capital. You can view that glass half full, glass half empty in terms of what it means for volatility and stability. But I guess we'll, at this point, take it however we can get it.
You bet. And we didn't have a lot of tariff talk really to move the soybean market today. So what were we trading? Because yesterday we got smashed by the Argentina rains. So what were we trading today?
Yeah, I think it's an interesting trade. We had what I'll call kind of an ugly opening. We tried to open a little bit higher, immediately found some selling, got to be a dime, or more lower. And immediately, when we got there, we did not find any panic selling. We didn't find any funds who've been long the complex willing to get out at those levels, and the buying immediately started back in the recovery. Now, we didn't rally a whole lot, and beans here are, corn is holding relatively close to its recent highs. Beans were more of that 20 cent away from those recent highs last week, but in doing so, we're kind of holding the thing together here a little bit, Michelle. And I think it's interesting to kind of watch what happens here. We are in the face of a lot of trade uncertainties in terms of tariffs and what's being proposed, and particularly with China as it relates to soybeans. And certainly we have seen better rains, stabilize a good portion of the crop in southern Argentina here this week. Rain totals anywhere from 1.5 inches up to 5 inches. We've got a little bit of a dry break going into early next week, and it looks like some rains will return. So certainly the soil moisture indicators were out this afternoon. They were up between 3% and 6%. The crop conditions have yet to follow, but I think we suspect that they will here. So, we're definitely stabilizing crop ideas there. They've taken their lumps. They're definitely below some of the early season ideas in terms of where the crop is going to land, but also very far from a disaster in terms of that Argentine soybean crop.
Yeah. And we did see kind of some disappointing exports on soybeans this morning, but we kind of expect that this time of year as we transition into the Brazil crop, right?
Yeah, 4-week lows for soybeans. We're definitely following the seasonal trend here. And when we look at what's happening in Brazil, harvesting of a record crop, this is what should be happening. We're putting the brakes on, despite, I guess, what we'll call disappointing numbers to a few in the trade here today, or something on the low end of trade expectations. We're still on a pace that gets us to, if not a little bit above USDA's full year target on a seasonal basis. So really no red flags in that process. We are watching what's happening. We got off to a little bit of a late start with harvest in northern Brazil. We had some port issues already developing with delays, but it hasn't led to any additional U.S. soybean sales yet. I think the caveat there is whether the trade feels like we can get some kind of a deal with China that promotes goodwill purchases regardless of pricing. And I think right now the over-under on that is probably leaning towards the under.
Yeah. And unfortunately, we did get back under the 200-day moving average there in the soybeans today. So I guess we'll have to kind of watch that. Corn couldn't close March above the $5 mark, but the corn market is just consolidating under the recent highs?
Yeah, I think corn is showing its relative better fundamentals and relative better strength versus the corn, or excuse me, versus the soybean or really anything else in the complex for that matter, Michelle. And the sticking points, the resistance points on top have been the inability for that spot March corn contract to get at or above the $5 mark. And the same thing with the 200-day moving average in soybeans here. And so those are the marks that we're trying to push above. And I think we have to be a little cognizant here. Maybe in years past, we talked a lot about market tops or bottoms coming in a V fashion with a very sharp move in one direction or the other, followed by a failure and a quick reversal. And when you go back in the last maybe 3 to 5 years, those tops and bottoms have been more rounded out. They've come on a more broader basis where we've tested support, or in this case resistance, a number of times and been unable to get through it and finally kind of given up the ghost. I'm not saying that's the case here, but certainly I think it feeds a market narrative where to kind of keep the momentum to the upside and kind of keep some of this fresh money, outside capital flowing into the grain complex. We need to challenge and probably get above those levels here in the next few weeks.
Yeah, I was going to say the funds are pretty loaded up long there in the corn market. If they don't get that, is the market vulnerable to them trying to liquidate?
Yeah, I mean, there's definitely some concern out here about the what I'll call a little bit of the excessive length or a high historical amount of length in the corn market by the funds. Now, it doesn't mean they can't buy more. There's been a lot of cases historically where once they get to this level of length, they tend to stay at those levels for weeks, if not months. We tend to continue to accelerate the market above that. Right now, we don't have the fundamental story or narrative or item that we can point to that's going to do that. But in the context of looking at where corn stocks are at, what the USDA did between the Nov and Jan reports, how that's affected global stocks of corn, particularly among the exporters, and how tight that situation is, we really don't have any room for a problem in Brazil's safrinha crop, planting, development, and harvest this year, let alone what could happen in the U.S. here. And of course, we're expecting another 3 to 5, I should say, producers to add 3 to 5 million additional corn acres here in the U.S. this spring. And I don't see any reason that doesn't happen, but certainly it's not a guarantee.
No, but it is going to be a headwind if it happens for sure. Cattle market had some steep losses today, lower cash and cutout values kind of weighing on that market. Do you think cash came in at what, 206 and 328?
Yeah, I mean, definitely the cash rate that we've seen this week, $2 to $3 lower than what it's been. Looks like packers are trying to slow things down quite a bit. May not be very aggressive buyers this week. It also looks like packers aren't very anxious sellers and may hold back a little bit and force them to pull some contracted. But I think that's what's happening here. We've seen these kind of head fakes in the cattle market before. We get some big liquidation on the part of the funds. But when I look at the CFTC data from last week, essentially we had the fund length at a record coming in on the report last Friday and carrying that forward into this week. I think what's different about those past, events and the recovery and the subsequent recovery that we've seen is that this time around we do have that weaker cash market. You can look at it in the cutout market down over $5 yesterday, down another, I think, $1.30 here at midday today. You can look at it, in terms of the live cattle and where they're bid. You can look at it in terms of packer margins here being deeply in the red, about as deep, about as negative as we've seen them in our database. So certainly some red flags here and some caution in the wind here in terms of where that fund length is. And it doesn't always have to follow the fundamentals. Whether we think the fundamentals are bullish or not, the money flow is going to dictate kind of what's happening here in terms of how this fund action goes. And I think that's what we've seen here the last few days. Cattle closing lower 5 of the previous 7 sessions here.
Yeah, and you closed April below the $200 mark, which was kind of the breakout point there. So did we do technical damage, which would infer maybe a bigger correction?
Yeah, we need to get this thing back on its feet here a little bit. And certainly, like I said, we've been able to do that in these past corrections. But this one, I think, with the weaker cash is a little bit more of a concern. So tomorrow's action, I think, in terms of what, we tend to push this cash trade until Friday. I think what happens there, if we're $1 or $2 or somewhere close to steady, it's one situation. I think if we're $2, $3, $5 lower off of last week, it's going to be a bearish signal here a little bit. So the market is waiting to see what happens, and hopefully we can get that recovery. But I think you have to be a little bit cautious.
And despite the lower day in cattle, hogs rebounded. And is that the strong export, strong cash? What do you think moved that?
Yeah, a little bit the opposite situation. We've seen the fund length in the hog complex pared back just a little bit, gives them a little bit more room or a little bit more ammunition on the upside. We've seen, I think, they're a beneficiary of the rotation out of capital, out of maybe cattle and coming into the ag markets, some of that finding its way into wheat, as we talked about, but I think some finding into the hog complex as well. And those cash markets, whether it's the national value, the index, the cash hogs, all kind of moving their way up here. We've got cash hog weights, or excuse me, live hog weights, very close to where they were a year ago, where we're still above, well above, historical measures in the cattle complex. So production looks like it's, it's where it needs to be. It's showing a sign, trying to tell us that the market is fairly current here. We'll have to see how those things line up going forward, but some good signs there in the hog complex.
Thanks so much, Dave Chatterton with Strategic Farm Marketing. That is Markets Now.